Hello class, this is Dr. Fenton. In this video we're going to cover Chapter 2 of your Financial Accounting textbook. Now I need to warn you that the material in Chapter 2 is quite lengthy. It's very detailed. We're going to go through a variety of accounting journal entries. We're going to post the numbers to the accounts, bring those up to date. We're going to talk about debits and credits. So there's a lot of material here, so it will take a lot of time to study. So again, don't use this video as a replacement of reading the chapter yourself. You still need to read it yourself. You need to read it, follow the examples through, come back to this video again if you need to, but you need to read the chapter yourself. Alright, so good luck and let's get started. So I'll bring up the page. Here it is. So the title of this chapter is The Accounting Cycle During the Period. In this chapter we're going to continue with the business we introduced in the previous chapter, the soccer company, the academy. And so we're going to go through various transactions. You can read the learning objectives here yourself. So let's go to the next section. Here we go. And what we're talking about is the accounting cycle. And the accounting cycle is just going from start to finish to finally take the numbers from the transactions, get those into the accounting records, and finally prepare the financial statements at the end. So it's a complete cycle. In this chapter, we're also going to talk about external transactions. This will be where you're dealing with someone or some business outside the company. So this can be buying inventory from a supplier, paying rent, paying salaries to your employees, paying utilities and so forth. So these are external transactions. Now in the next chapter, chapter 3, we're going to talk about internal transactions. Here are the steps we're going to go through in this chapter. First of all, we're going to discuss the documents, the external transactions, try to figure out what has happened. Did we earn revenue? Did we pay an expense or whatever? Step 2, we analyze the impact of the transaction on the accounting equation. Step 3, we have to assess whether it results in debits or credits to various account balances. And this is going to be new to this chapter, debits and credits. We're going to record the entry into a journal using debits and credits. Then at some point in time, and for our case after all the transactions, in step 5, we're going to post the transaction dollar amounts into the general journal. That'll bring the accounts up to date. And in step 6, we're going to prepare a trial balance. And the trial balance will be used just to make sure that the accounting equation still balances after all the transactions. Next section. Remember, we saw this equation in the previous chapter. So with every transaction, after we post the entries for every transaction, and at all times, just in general, the assets must always equal the liabilities and stockholders' equity. This must hold true at all times. Again, if not, we have an error someplace and the accounts are not going to balance. So you can look through this, read that yourself. Now let's look at these transactions, 1 through 10. These are the transactions for the soccer academy. And these, in fact, were the numbers we were using in the first chapter. We just did not get to that in detail at that point. So we're going to take each transaction step by step, analyze it and its impact on the accounting equation, then come back and talk about debits and credits and see how to use debits and credits to make journal entries. Okay? So look at the first one. Remember this from the previous chapter. We sell $25,000 of common stock to the stockholders, to the shareholders who are going to be the owners of the business, and that gets the cash into the business so we can start having cash to operate. Also on the same day we decided we need to borrow $10,000 from the local bank, so this will be a liability. And then number 3, you can see we purchased the equipment, if you remember that one, for $24,000 cash. So let's just start through each of these and analyze them. So issue common stock. The company at the very beginning needs to get cash and other assets into the business. So to get cash in the business right away, the corporation sells stock to the new stockholders, and the new stockholders give $25,000 cash to the business, to the company. And so number one here, what is one account in the accounting equation that is affected by this transaction? And does that account increase or decrease? You need to answer these questions for every transaction. You have at least 2 parts to every transaction. This is part number 1. And we decided, yes, we know cash is coming into the business. So the cash account of the company is increasing. It's going to increase by $25,000. Number 2, what is a second account in the accounting equation that is also affected? You always have to have at least 2 accounts affected by every transaction. You could, and we'll see later on, you could have 3, 4, or 5 accounts affected in the same transaction, but you always have to have 2 accounts affected. So you answer the question here, why did the company receive cash? Well, because it issued common stock to the stockholders. So what we're going to do is increase the common stock account. Look at the effect on the accounting equation. Cash went up $25,000. That's on one side of the equation. The stockholders' equity section went up because the common stock account went up $25,000. So with the transaction itself, we only have one transaction at this point, then the accounting equation holds true, $25,000 on one side and $25,000 on the other. One thing I should point out here, and this gets people confused, the cash account is the only place where we have actual cash. So we have $25,000 cash in the business. Now we had to put $25,000 in the common stock account to show why we received the cash. This does not mean that we have another $25,000 in a common stock account. We don't have $50,000 in cash. We only have $25,000. But you have to identify if cash comes in the door, why did it come in the door? Oh, because we sold stock. So we enter $25,000 into the common stock account. So please be aware that the only place we have cash in the business is in the cash account. No matter what other account is affected, we put cash in the cash account, and when we pay it out, we take cash out of the cash account. No other account is like a pile of cash sitting there. Okay? Let's go to the second transaction. We borrow money from the bank. Let's pull this up. Cash comes in the door again, $10,000 in cash. Why did this cash come in? We borrowed money. So the answer to number 1, the cash account will be affected. The answer to number 2, the notes payable account will be affected. You know, we had to sign a note at the bank. They're not going to let us just walk out of the bank with $25,000 cash and not sign anything. So we're going to sign a note. They're going to charge us interest, and we'll have a certain due date, and that's fine. So we're going to use an account called notes payable, and that is a liability account. We owe the bank this money back, a little bit later, maybe. Forgot what they don't tell us the terms. Maybe in 6 months, maybe a year, we have to pay the $10,000 back plus interest. Look at the impact on the accounting equation. Number 2 here, cash goes up $10,000. Notes payable goes up $10,000. Cash then has a new balance of $35,000. Notes payable, liabilities, $10,000, and common stock under stockholders' equity, $25,000. Now, liabilities plus stockholders' equity, 10 plus 25, $35,000 in total on this side, the right side, and we have $35,000 on the left side, the assets. So assets still equal liabilities plus stockholders' equity. It still stays in balance. Number 3, let's use cash to buy some equipment. So we used $24,000 cash to buy some equipment. Here, cash is going out the door. So we can see that we're going to lower cash by $24,000. And like I said earlier, you always have to have at least one other account impacted. So you answer the question, why is cash going out the door? Because we purchased equipment. So we increase a new asset account called equipment for $24,000. Notice nothing on the right side of the equation is affected. I never said you had to have an account on one side of the equation impacted and on the other. You always have to have at least 2 accounts impacted. They both can be on the same side. So with cash having $11,000, equipment $24,000, it totals $35,000. So $35,000 on the asset side still equals $35,000 on the liabilities and stockholders' equity side. So very important here, you don't have to have a transaction on both sides, part of the transaction on both sides, but you can have both accounts on one side of the equation, and it'll balance out. -24, +24. Nets to 0, so the total balance before 35 equals 35 after. Transaction 4. Now, for some reason, they had to pay the rent 1 year in advance, for every month 1 year in advance. So they paid $6,000. You don't see this happen too often. I guess maybe it could. A better example here probably would be insurance. We always have to pay insurance in advance. But anyway, they had us pay rent in advance. Now, when we pay rent in advance, we don't show that as rent expense right away. We have an asset we've paid for. We have the right to use the building for the next year. That's a resource that we have we're going to use. That's an asset. So we're going to pay this, so you can see right away we're going to pay out $6,000. Here's the equation. We pay $6,000, and then you answer the question. Why did this $6,000 go out the door? Because I paid for rent in advance. And we're going to call this prepaid rent, and it is an asset. So probably in this course we're going to see only a couple of prepaid items, usually prepaid rent and prepaid insurance. In this case, prepaid rent. So again, only the assets are affected. You're trading one asset, cash, for another asset called prepaid rent. The assets still total to $35,000. And since we haven't changed anything on the right side, it still totals $35,000. So you can see with every transaction, the accounting equation balances. This side equals this. And you think, well, there's nothing on this side to balance. That's okay, because look at this one. -6, +6, 0 on this side, 0 effect on this side. So the totals of both these sides, this still totals to 35, this still totals to 35. Okay? Now we're going to purchase supplies on account. You know what supplies are, but the key words here are on account. On account means you haven't paid for it yet. So you purchase something on account, the vendor, the supplier, is going to let you take the supplies today, and they're going to have you pay for it later, maybe in 30 days or 60 days. Whenever you're dealing with your suppliers and you have this liability pop up, it's going to be a liability, then we're going to call it accounts payable. So let's take a look at this one. Supplies, when you first buy those, you don't use them all at once. So we're purchasing another asset. And so we have another new asset account pop up, supplies. We enter $2,300 in it. And then we owe, it's a liability, we owe the suppliers $2,300. Don't put this $2,300 in notes payable. This is where you have a formal note, usually from a bank, where you sign and pay interest, where the vendors might give you 30 days to pay and not charge you interest. So use accounts payable for your suppliers of inventory, of regular like office supplies and so forth. Here we went back to having accounts on both sides of the equation affected. Increase in assets, supplies are going up. Increase in liabilities, accounts payable is going up. And now that means total assets went up. So we're now at 37.3 on this side. Liabilities and equity still 37.3. They still balances. Now this part is where it gets a little bit confusing, and you'll need to come back and maybe view this part of the video again, or go back and read this section of the chapter again. Stockholders' equity is the area where most students have the most trouble. Assets, they're easy. You have cash, you'll have inventory, you have equipment, you might have land, buildings, supplies, and so forth. That's easy to understand. Liabilities, also easy. You owe money to someone. You borrowed money from the bank. Until you pay it back, it's a liability. You bought some supplies on account. You owe your supplier some money. Okay? So assets and liabilities, fairly easy to understand. Now stockholders' equity, we need to expand this out Because as you can see, we had common stock earlier, and now we're going to have something called retained earnings. Retained earnings, just like the title says, these are earnings, in other words, profits or net income, that have been retained in the business. So whenever we have net income that will increase retained earnings, a net loss would decrease it. Dividends are some of the profits being paid to the owners that will decrease retained earnings. Now, since I said net income increases retained earnings, that means revenues, when we actually earn revenue, that will cause retained earnings to increase. Whenever we pay expenses, that will cause, you can see the minus sign here, that will cause retained earnings to decrease. Whenever we pay dividends, another minus sign, that will cause retained earnings to decrease. So we've branched this out. So there's quite a bit going on under stockholders' equity. There's the owner's equity side here, the common stock and so forth, and then the retained earnings side, which, like I said, the earnings that have been retained in the business, but this is impacted from revenues, expenses, and dividends. So try to keep this chart in your mind, but then come back and review this if you need to. Okay, the next one. Let's see. Provide services to customers. Here we go. Sorry for the scrolling. We provided soccer training to customers for cash, $4,300. That means we provided training and they paid us immediately. They paid us cash immediately. And the cash, this can be a check and so forth. So we'll just call it cash for now. So let's analyze this transaction. What has happened? We provided a service. We were paid cash. So we know what we do with cash, the cash account, when cash comes in the door. So you'll take $4,300, increase the cash account. That's usually the easy part of this. Then you answer the question, why did this cash come in the door? That's because we earned some service revenue. We're going to place this under retained earnings. You know, we saw that chart a minute ago. Whenever you have revenue, it increases retained earnings. Okay. So providing training to customers, we're paid cash $4,300. You increase cash $4,300. You increase retained earnings because of revenue $4,300. Everything still is in balance. We have 41.6 on this side, 41.6 on this side. The actual equation itself, the actual transaction itself, plus 4,300 on the assets, plus 4,300 under equity, so everything stays in balance. That was an example of revenue when we were paid cash. Now here's an example of earning revenue when the customers are going to pay us later. So we saw a minute ago, when we buy supplies on account, the suppliers are going to allow us to pay later. We might do the same thing for our clients. So here we have some customers, some clients that came in. We provided the training. We've already done this. And they are going to pay us maybe in 30 days. We give them an invoice. $2,000. So we provided $2,000 of training, and they're going to pay us cash at some future time. We don't have the cash today, but an activity has occurred, an external transaction has occurred. Had provided services. We provided that. We've earned that money. They are going to pay us later. So how do we record something where our customers or clients owe us money? We're going to use a new account called Accounts Receivable, and it's going to be an asset. So let's look at this transaction. Number 7. Another asset account, Accounts Receivable. This account shows when our customers or clients owe us money. So we provided services, they owe us money plus $2,000. Why did this asset account go up? Because we earned some more service revenue. Now, in accounting, we use, and we'll talk about this later on in more detail, something called accrual accounting. We record revenue even though we don't have the cash in hand just yet. So when we earn it, we record the revenue, even though they're going to pay us later. This transaction, number 7 here, records everything that's happening. We've earned the revenue. We provided the service already, and the customer still owes us money. So don't think that you always have to record revenue and cash. Here we earned revenue and they owe us money. They will pay the cash later. We'll see that in the next chapter. They will pay us the cash later. Okay? Everything still balances. We're up to 43.6 on one side and on the other. Transaction 8, and we're going to receive cash in advance for customers. Here's the opposite of number 7. Here we are receiving $600 cash from customers, but we are going to provide the training later. So think about this. We have the cash in hand today, but we have not earned it. So we know we're going to increase the cash account. The cash came in the door. But how do we record this coming in the door when we haven't earned it yet? We don't record it as revenue. It does not go into the Stockholders Equity account. In fact, we owe them something. We owe our customers the services. They paid us. We have not provided the services yet. We owe them the service. So we need to record a liability. We owe someone something. Let's look at this transaction. Number 8. This comma should not be here. $600. That comma should not be here. And so, anyway, just ignore that. So $600 is the increase in cash. And look, we have a new liability account called Deferred Revenue. Deferred Revenue means, think of it a couple ways. We owe our customers, our clients, a service. We owe them something. We have not provided it yet. And the other thing, we're going to earn this later and report it as revenue later on. We don't report this as revenue today. We don't increase the retained earnings account under Stockholders Equity today. A lot of people try to do that. They think, well, customers gave us money, that must be revenue. Not if we haven't earned it. If they gave us money in advance, just like you taking out a magazine subscription, you pay in advance, like a year in advance. The magazine company, the publisher, owes you something. They owe you that magazine every month. Okay? Same way here. Cash came in the door. We owe a service to our customers. It's a liability. This one's sort of odd, but that's what it is. We call it deferred revenue. Don't let this title confuse you. Don't try to put deferred revenue under retained earnings. Deferred revenue means we have not earned it. We owe a service to a customer. Okay? Everything is still in balance. 44.2 on one side, 44.2 on the other. Okay? So 2 more transactions, almost done with these. Now we have our employees, we need to pay them, right? So we're going to pay the employees a total of $2,800 cash for salaries. They worked for us. Well, cash is going out the door, so you know you're going to decrease the cash account. So think about what other account you would change. Well, salaries expense. Expense impacts retained earnings, which is Stockholders Equity account. And expenses, if you remember, they decrease net income. They will decrease retained earnings. Let's look at this transaction. Cash went out the door. That's the easy part. You know that. You wrote the payroll checks. On the other side, salaries expense, sort of going off the page here. I can move that over a little bit. Salaries expense, $2,800 negative. Don't forget that. Your revenues you added. Your expenses you're going to decrease here. So both sides of the equation will decrease. The assets went down. We're down to 41.4, and the total of liabilities and stockholders' equity also went down, also down to 41.4. Everything still stays in balance. So just a comment here. You can see how accounting is very detailed. You look at the transaction, you analyze it. We need to record exactly what has happened. Exactly what has happened. So the last transaction will be dividends. We decided to pay the stockholders, the owners, $200. We've had a good month, so let's pay the owners $200 in cash dividends. Remember, a cash dividend payment is not an expense. It is not an expense. It's going to look like it here in just a second, but it's not an expense. We're paying cash, so you know your cash account is going to go down. Let's look at the transaction. Number 10. Cash, this is the easy one, negative 200. All the way over here, minus, under retained earnings, $200 for dividends. Don't call this dividend expense. Move this over, just dividends. So even though it looks like an expense, it acts like an expense under the retained earnings column here, but it will not show up in the income statement. It is not an expense. It's a return of some of the profits to the owners. So don't record this as an expense. All right, so those were the 10 transactions, and I think we're about done here. Okay, here's a summary of all the transactions, just in one spot. I can barely get on the screen, not quite. But you can go through each of these. We've already recorded each of these. Nothing is really new here. You can find the totals in each account, and then here is the final totals for assets, 41.2, and the final total for the right side of the equation, 41.2. These are the same numbers we had right after this last transaction right here, 41.2. So this is a good item to look at, this chart. And here's an example you can work through yourself on your own, and it'll be good. It'll be real good practice. All right, next section. Debits and credits. Now, this is going to be very detailed. You thought the last section was detailed, where we went through 10 transactions, and we saw each one's effect on the accounting equation. All that still holds true, but now we need to talk about exactly how we enter those numbers into the accounting system. How do we get those into the journal entries? How do we get those to the ledger accounts and so forth? And we use something called debits and credits. So just bear with me. This is going to be very, very detailed, but this is what we're going to use for the rest of the course. Now, debit. The one thing you say about debits is that debit always means the left side of an account, and the credit, on the other hand, means the right side of an account. Now, that sounds easy at first, but then the rules you have to remember will be that on the assets, a debit to an asset account means you're going to increase that account. A credit to an asset account means you're going to decrease that account. So think about cash. Cash is an asset account. So from now on, whenever we increase the cash account, we're going to debit the cash account. Whenever we pay cash out and we need to lower the cash account, we need to credit the cash account. So instead of me saying increase and decrease very much in the future, I'm going to say debit and credit for the assets. So you might think, well, that's not too bad, right? Look at the liabilities. The rules are completely opposite as to what the debits and credits do. Now, it's still debit on the left side. That doesn't change. But when you debit a liability account, like accounts payable or notes payable, you're going to decrease that account. When you credit an account, a liability account, you're going to increase that account. I'll go ahead and jump over here, do the same thing with the stockholders' equity accounts. A debit means decrease, and a credit means increase. Now, besides the overall accounting equation, where assets will always equal liabilities plus stockholders' equity, another equation will hold true is that debits will always equal credits. That'll hold true for every transaction. That'll hold true for the entire balance sheet when we finally get to debits and credits in the actual accounts themselves. So here's another equation to remember. Debits always equal credits. Okay. Let's scroll down a little bit more. Here's another chart where we are expanding the stockholders' equity section. And a minute ago I said this is a very confusing area at first, and it is. Let's look at each of the individual accounts under stockholders' equity. In the common stock account, the general rule for a stockholders' equity account holds true. For the common stock account, we credit that account to increase it. We debit it to decrease. Retained earnings increases with a credit, decreases with a debit. Revenues decrease with a debit, increase with a credit. And you think, well, what's different here? Everything is the same. Look at the expenses. Look at the dividends. the rule switches. And that's because we subtract expenses and subtract dividends to find out our new balance in retained earnings. So for the expense accounts, like salaries expense, insurance expense, utility expense, whatever the expense account is, they increase with a debit and they decrease with a credit. Same with dividends. Whenever we pay dividends, we're going to decrease the cash account. We're going to increase the dividend account with the debit. Okay. So here's another chart. You'll need to memorize all these debits and credit rules in addition to the regular rules we've had before. Let's see what else we have here. Some people like to try to memorize the rules using dealer. I guess you can do that. DEA, dividends, expenses, assets increase on the debit side, the left side. Liabilities, owner's equity, and revenue increase on the credit side. Okay, so they increase here with the debit, these increase with the credit. So you can memorize that if you want to. Let's see, here's an example you can work through. So do that on your own. It gives you the solution. Next section. Now let's actually enter the transaction into a journal. Now here's where we're finally getting to real accounting. We've analyzed transactions. Now let's get those into the accounting records themselves. For every transaction we're going to have in the future, we're going to enter a debit and a credit. You always have to have at least one debit and one credit for every transaction. You can have multiple debits and maybe one credit, or vice versa, but you always have to have at least one debit and at least one credit. For every transaction, your total debits equal your total credits. Maybe you just have one debit and one credit, that's easy. But if you had like one debit and a couple of credit accounts credited, the dollar amounts must equal. You know, the total dollar amount of the debits must equal the total dollar amounts of the credits. Okay, so here's the first one. This is a journal entry. Let's go back to the same 10 entries that we just had. Hopefully you understand those fairly well now. Now let's see how we enter those into the actual accounting records. So here's a journal transaction. Remember, when we sold stock to the stockholders, cash increased $25,000 and the common stock account increased $25,000. So the journal entry would be debit cash, $25,000, credit common stock, $25,000. Now if you notice here, debit is put in the left column and credit into the right column. Always do that. But over here, whenever you write the account title, always enter the account you're going to debit first and put that over here next to the margin. Whenever you write down the account title for the credit, you indent that. So indent the account title for the credit. So we're going to debit cash $25,000. We're going to credit common stock $25,000. Turning that into what we learned before, debiting cash $25,000 is the same as saying increasing cash $25,000. Crediting common stock $25,000 is the same as saying increasing common stock $25,000. So that's what we need to do from now on. Find the accounts that were affected, find out if they are increased or decreased, find out which one or ones will be debited, which one or ones will be credited. Let's do that for the other transactions. The second transaction, this is a chart of accounts, various accounts, assets, liabilities. We've already used all of these, nothing new here. And let's go to the next section here. This is a general ledger account. So we'll get to this in a minute, debit, credit, and the balance. But go back to transactions. We've already seen this one. We debit cash, credit common stock, $25,000. Now what we're going to do, and the computer systems for accounting, they will do this automatically. When you do this by hand, usually you wait to the end of the week, end of the month, or whatever, and post this by hand. So posting is taking the debit you had in the general journal, this journal entry, and put it into the cash account for the for cash, for the general ledger account for cash. So we're going to debit cash $25,000. That's the new balance. You can see this T. That's why accountants call this T accounts. The debit side, credit side, and this is just an account balance out to the right. For the common stock account, you have a separate account for it. We are increasing it with a credit, so you put it down here as a credit. And the new balance, you went from 0 to $25,000. So that's what happening. That's happening for every transaction. You make the journal entry, and then at some point, you post the dollar amounts from the journal to the general ledger accounts. That's what these are down here, general ledger accounts. And this will help us keep up with what kind of balance we have in each of these accounts. Transaction number 2. Here's the entry. Let's look at the entry first. Remember, we borrowed $10,000 from the bank. Let's debit cash $10,000, credit notes payable $10,000. We are increasing the cash account. We are increasing the notes payable account. Now, some people think when you debit, it always means increase. Depends on the account. Remember that. Some people think a credit always means decrease. No, like here, we are increasing the notes payable account because we owe money now. Before we borrowed this, we did not owe any money. But we borrowed $10,000. Now our liabilities increased to $10,000, so we have to increase the notes payable account. It's a liability account. When you post these numbers, take $10,000, enter it into the cash account on the debit side. That means you're going to increase it. So now you go from $25,000 plus $10,000 equals $35,000. So the new balance in cash is $35,000. The notes payable account, this is the first entry you have in this account. So the balance went from 0 to 10, and we're increasing the notes payable account with a credit. And this is like a T account here. Okay, T account for cash. This is like a little summary of the general ledger account. We did have $25,000, increased to 10, now at 35. We had 0 in this account before. Put an entry in, and the new balance is $10,000. You say, well, this doesn't balance. That's because we don't show all the accounts here. We're just showing the cash account and the notes payable account. We're not showing common stock and any other account. Number 3, purchase equipment. So here we're going to debit equipment and credit cash. Now, why are we crediting cash? Because we're paying $24,000 out the door. Why? We're getting equipment, new equipment. So we're increasing this asset account called equipment for $24,000 and decreasing this asset account called cash, $24,000. So total debit, total credit, balances. And you can see what happens to the equipment account. 24 goes to 24. It was 0, went to 24. Cash now decreased. We did have 35 in it, and now we took 24 away. We only have 11,000 in it after this. So what the book has done here, instead of showing all these lines and all these postings and the balance out to the side, now they're showing the T accounts. So here's the equipment went up and the cash account went down. If we pay for rent in advance, remember the prepaid rent account is an asset account. So we're going to debit the prepaid rent account $6,000. Cash is going out the door, so we're going to credit cash $6,000. The prepaid rent account, which is showing this T account, it was 0. We put $6,000 in. The balance is now $6,000. What happened to the cash account? Well, it went down. We did have 11 after transaction 3 had $11,000. Paid $6,000 more out. We're down to $5,000. So you add these debits, subtract these credits, that gives you the new balance in the cash account. So we're down to $5,000 in the cash account. Purchase supplies on account. Supplies, before we use them up, is an asset account. So we increase the supplies account $2,300. We're not paying cash for this yet. remember, they told us we could pay later, maybe 30 days, 60 days, whatever. So we're going to credit the accounts payable account, another liability account, $2,300. What happens to those two accounts? The supplies account went from 0 to 23. The accounts payable account went from 0 to 23. Here's where we provide training to customers and they pay us cash. So cash goes up 43. Why did this cash come in the door? Because we earned the money. We earned the money. So this is a revenue account. Also impacts stockholders' equity. So we're increasing revenues with $4,300, increasing cash $4,300. Here are the T accounts. Cash is now up to 93. Add all these, subtract all these. Service revenue, this is our first revenue, went from 0 to 43. Providing services to customers on account. Remember, we have provided the services, they haven't paid us yet. They're going to pay us in the near future. They owe us the money. So here's revenue we have. Don't try to automatically record this as cash because we don't have the cash yet. They owe us the money. So remember back earlier, we debited or we increased the accounts receivable account. So we're going to debit to increase accounts receivable. We're going to credit to increase the revenue account, which is part of stockholders' equity, for $2,000. That's the journal entry. What happens to the accounts themselves? Accounts receivable. This is our first posting to it. The balance is now $2,000. This is our second posting to the revenue account, so it goes up $2,000 to $6,300. Transaction 8. On this one, remember that customers paid us in advance. We've not earned it yet. We've not provided the service. Cash is coming in the door, so we need to increase the cash account with this debit, right? Deferred revenue is the liability account. This shows that we owe someone something. We owe our customers $600 worth of services. They paid in advance. Cash comes in the door, increased cash. We haven't earned it yet, so don't record revenue and don't let the title deferred revenue trick you. This is not a revenue account. This is a liability account. It's deferred revenue. We owe the service to the customers. Okay. What happens to the cash account? You can see a lot of entries in cash now. Add all the debits, subtract the credits. The balance is now $9,900. The deferred revenue account, a liability, our first entry, we now have $600 in it. Okay, two more entries. Pay salaries to employees. Cash is going out the door, so we decrease the cash account $2,800, that's the credit, and we increase the expense account. Now remember, the rule for expenses, we increase it with a debit. So we're increasing the expense account. That's going to have the effect, though, of decreasing stockholders' equity, because as we increase expenses, that will lower net income, and net income goes into retained earnings, and so it's going to lower stockholders' equity. But we are increasing expenses $2,800, and decreasing cash $2,800. Let's look at the T accounts. This is our first entry into salaries expense, so the balance is $2,800. Cash, again, you have another debit, another credit popping up over here. Subtract that out. We're down to $7,100. And now the final entry, pay dividends. Cash is going out the door, so you know you're going to decrease cash. But we have a separate account for dividends. We're going to increase dividends with a debit. So debit dividends, it increases dividends, $200. That also has the effect of lowering stockholders' equity, because dividends, being a return of some of the profits to the owners, that's going to decrease retained earnings, and that will also decrease stockholders' equity. So debit dividends and credit the cash account. That's our first entry into the dividend account. Now it has a balance of $200. We have another credit in the cash account, so now we have a number of debits, a number of credits, add all your debits, subtract all your credits, and that gets you the balance in cash, $6,900. So now they just show you every entry, every journal entry we just went through. You can look at these all in one place. And this shows you all the T accounts for all the accounts. Quite a bit of activity in cash. Okay, a lot of these accounts just have one entry, so those are the balances you can see easily. We have 2 entries in the service revenue account, and all the others have just one entry in them. Expenses 1, dividends 1, so forth. So when you add all these asset accounts together, they will equal all these liabilities plus the stockholders' equity accounts. Because remember, your supplies, your salaries expense and your dividends will decrease, but when you net all these together, the equation will still balance. And there's an example you can work through yourself. Let's go to the next section. The trial balance. The only thing the trial balance does is to make sure, after all these entries we've gone through, where we've made the journal entry, we've posted all the numbers to the actual accounts themselves, where we use T accounts, the ledger accounts. You want to make sure before you go any further, all your debits equal all your credits. So here's the trial balance. And these asset accounts have debit balances, so drop those in. We just saw those a minute ago. Liabilities, we have 3 of those. Common stock has a credit balance. Retained earnings is 0 for now. I'll explain that more in the next chapter. Don't worry about that now. The dividend account has $200 debit. Service revenue, a credit balance. Salaries expense, a debit balance. So whatever debit or credit balance you had earlier in those accounts, put those the same way in this trial balance. Then your total debits will equal your total credits. Remember, this is not a balance sheet. This is not a balance sheet. This is a trial balance just to make sure your debits equal your credits. So this 44.2 is not total assets. And this is not total liabilities to stockholders' equity. That's not what this is showing. This is showing that our total credits, our total debits equal our total credits. Let's see. Okay. Next section. A review in through here. This would be a great page to come back and look at in your textbook, your ebook. Objectives, and we're getting to the end of chapter material. So, anyway, class, this is a long video with a long chapter. It's a lot of detail, but this is where we're finally getting into the accounting system itself. Analyze the transactions, what accounts were affected, were they increased or decreased, do we debit or credit those accounts, post the numbers from the journal, general journal into the general ledger T accounts, bring the balances up to date, and now before we get into preparing the statements in the next chapter, let's make sure that all the debits equal all the credits before we go further, and that was the trial balance. So read the chapter in detail, review this video again if you need to, and good luck with your studies.